There you go.
We want to go back to the beginning, don't we? That's okay. Well, that's the first one.
Hi there. Good afternoon. Thank you for joining us at the iON series. This is a series that started 3 years ago, and we took it across the regions through Ontario and various places. And now we've looked at pivoting and
thank you to the to Interactive Ontario for organizing this presentation today. This is something that we've done a couple of times before, though not always with the same people. But it's great this time. It's streamed and hopefully will be available to others on the web over the next few months. Let me start by introducing the panelists today. We have from BDC, Amanda Hutteri. Hutteri. I'm sorry, gosh, I thought I was going to get that right. Amanda Hutteri. I appreciate that. Amanda Hutteri is with the BDC. She is an account manager in the acquisitions department at BDC. We have to her left Tanya Lahiri, and Tanya is with the Toronto office of the Royal Bank of Canada. She's a director in the Media and Entertainment Group at the Royal Bank of Canada. And finally, we have Amesika Baeta. Amesika is with the Export Development Canada. She's an account manager in the Small and Medium Enterprise Solutions Group. And so thank you very much, all three of you, for being with us here today. Let me just explain very quickly the format for what we're going to do today. First of all, I'm going to ask each of our panelists to describe, to give us a little bit of background on their company and on the products that they offer to the interactive digital media industry. And then secondly, what we've prepared for you is a case study in which we take an interactive digital media company and we move it through 3 stages, through the early stage, the mid stage, and then the mature stage of its development. And we ideally will show you not only how each of the company's products can assist in the growth and development of the interactive digital media company at each stage, but ideally how they can work together to create enhanced solutions by cooperating with each other with their respective products. So without anything further, I'm going to ask Tanya to begin the presentation by speaking about the Royal Bank of Canada and its products for the industry. Sorry, let me just very quickly thank Canada Media Fund, the event series partner, EDC and RBC for this event. And let's move on. Tanya.
Thank you, Mark, for the wonderful introduction. And thank you very much, IO, for actually hosting this panel. I think it's very important for everyone to kind of know the ecosystem that we work on and to emphasize that ecosystem where EDC, BDC, and RBC work together.
I'm going to interrupt for a second. Are you hearing back there?
Okay.
Is it possible to turn that mic on?
Hello?
Oh, perfect.
Is this better? Okay, perfect. So thanks very much, Mark, for the wonderful introduction, and thanks very much, IO, for organizing the panel. What I was saying before was I think it's very important for everyone to understand the ecosystem that all of us operate in and how EDC, BDC, and RBC work together at different stages of life cycle for a company. As Mark explained, I think the format we're going to follow is just a brief introduction and what each of us do in covering the industry, and then we'll go through a case study that we actually worked on, and it was actually a live case study. We've kind of not used the names and changed the numbers a little bit, but you'll see how at each stage of the company's growth, each of the partners kind of came in and helped the company. So just about RBC, we've actually covered the media and entertainment space for the last over 30 years, the digital media space for just about over 5 to 6 years now. I'm just going to cover the slide on what exactly we do in this space. So we deal with companies just covering traditional content producers that produce anything from online content as well as mobile platforms, more of the non-traditional content producers as well, more interactive content for online and mobile. We're also heavily focused now on the video gaming sector, which is up and coming now in Ontario and really growing. Online publishers, broadcasters and e-learning, and then technology software solution providers and some of the professional service providers. Do you want to move to the next slide? So some of the products and services or some of the solutions that we actually offer are, we do anything from the traditional lending as well as banking services, so operating lines, term loans, real estate loans, but we also do something very specific to this industry. So we also specialize in niche financing. So we do the SHRED as well as the OID-MTC financing. We've more recently looked at more cash flow financing with our RBC MES group as well. So, where the senior debt solution can't cover the whole solution, we also bring in our MES group as well as work with BDC as well on providing the solution. So apart from borrowing, we also do just traditional banking, cash management, as well as international trade services. FX, RBC is actually one of the biggest FX, USD CAD FX trader in North America. We also do investment services, as well as just introducing all our clients, as well as prospects, as well as anyone who we speak to extensive industry networks that we have access to. That's good.
Perfect. Thank you, Tanya.
Thank you.
Amanda.
So BDC is a federal crown corporation, and we exist just to support Canadian entrepreneurs grow and strengthen their businesses, and we do this through financing and advisory services. So we're different from the banks in that all the lines of credit, bank accounts, Visa cards, all of that still goes through the RBCs of the world. We just come in for the term debt to help with growth projects. So you can go to the next slide, sorry.
Okay.
So on the term debt, we do working capital for growing businesses. So if you're looking to hire new staff, if you're opening a new office abroad or locally, expanding your product offering, if you're looking to purchase a building, we can help with any of those kinds of expenses. And then we also have our growth and transition team. So they're a little bit different in that they work with high growth companies, extremely high growth companies, and they don't have a lot of tangible assets that you can take security on. So they can do a lot more higher risk lending and higher working capital amounts than we can on the traditional side, and this allows companies to maintain ownership management of their company instead of having to resort to finding external equity investors and then giving up part of their company. So it's a good option if you're finding yourself in a cash crunch and needing that extra working capital.
And Amesika.
Great, thank you. I'm an account manager for the GTA region. EDC, Export Development Canada, is a crown corporation, which means we are government mandated, but we are self-funding, we are self-sustaining. And our role is to support Canadian companies that are looking at expanding internationally. And we are part of a greater community of government entities that are there to support Canadian companies that are looking at expanding globally. We work very closely with BDC, as well as the Canadian Trade Commissioner Service and the Canada Corporation, Commercial Corporation, the CCC. And we all have our different roles when working with different Canadian companies. So our role in particular comes when risk mitigation, meaning insurance, and trade financing, so the actual financing of your international business and growth. At EDC, we strongly believe that exporting is the way to go. We feel that Canadian companies that export do better, they're more innovative, they're more productive, their business grows exponentially as a result of that. But we do understand that for a lot of Canadian companies, the idea of exporting into different markets around the world can be very daunting and it can be a lot of risk. So our solutions are developed to try to support those risky ventures, to try to make it less daunting. One of the first things that we do is accounts receivable insurance, which is something that we find that many of our clients that are in the digital marketing area can take advantage of. And this is when we protect you against non-payment. Non-payment can come in very different forms. It can be your customer goes bankrupt overnight, or what I like to call it's Monday and I don't feel like paying you excuse, or they can cancel a contract on you as you're doing your services. So we have different types of insurance products that can be leveraged to protect you against non-payment. Now, some of the key advantages of this is your banks love it, because when they're lending against your assets, they know that in the case that something goes wrong, EDC is there to support you. Additionally, it allows you to be more competitive when you're bidding on business internationally. The days where you could get full payment up front are long gone, especially in certain markets around the world. It's not even possible, where your customers were asking you for 30 days, 60 days, sometimes 180-day terms. That can be very daunting. So our policies are there to try to help you protect against that. And most importantly, what I call the sleep at night factor. So knowing that in the case something goes wrong, EDC is there to support you can be very beneficial. The other thing that we support you with, along with your banking institution, is bank guarantees. So often when you are expanding internationally, there's assets that the banks are not comfortable lending against. EDC is there to work with the bank to help finance, whether it's a specific contract, whether it's to increase an operating line or establish an operating line with your bank. And a lot of companies are starting to expand globally. It's opening up sales offices, opening up affiliates in other countries around the world. We are there to help you finance those ventures as well. In addition to lends against SHRED or OIDMT tax credits, if those tax credits are going to take some time before you get them from the Canadian government, we will work with your bank to help finance that. There's a lot of things that EDC can do, and this is just a high overview of the different solutions that are available. But if I can leave you with anything, it is that if you are thinking about doing international business, or you are doing international business, please come and talk to us, because we'd be happy to navigate that with you.
Perfect. Thank you. So the next stage is the case study, and what I will do is just introduce describe the company and the situation that they're in at the early stage, expansion stage, and then mature stage, and then I'll ask each of the presenters to take the lead, and then we'll bring in the other presenters to describe the role that their organizations can play at each of these stages. So in this example, the early stage, the shareholders were young, recent university graduates with limited personal net worth, so limited capacity to support their own growth. Initially, the company had 3 employees and worked from home. Small projects turned into larger ones, and the company eventually moved into a small office once they had a sufficient revenue base. So their revenue year 1 was $50,000, year 2 $200,000, and year 3 $1 million. So a fairly good growth trajectory, and obviously needing financial support to support that growth. So if I'll ask Amanda perhaps to describe BDC's financing solution at this point.
Yep. So this is a pretty typical case that we see on our smaller loans team. So there's a lot of early stage startup companies that come to us. For startups, they do have to actually have a business. It can't just be a business plan. But in this case, we do have a lot of younger entrepreneurs who don't have any personal net worth. So A, they don't have a lot to invest themselves, and B, they don't have anything that the chartered banks can, put a lien on and lend against. So we can do unsecured working capital financing. And in this case, we help them to hire their first developer. We can do up to 6 months of any new hire salary. And then later we did some follow-on financing to help them move into a new office, get some laptops for their employees, some desks, that kind of stuff. So some additional working capital to help them grow further.
Okay. Could I just ask you one question about that? I mean, we see that they're in revenue, obviously. They have a 3-year track record of revenue, so they're obviously selling their product. Does the BDC get involved even earlier than that or not? Do you like to see revenue?
Yes, so we do like to see revenue, or at the very minimum, if you don't have revenue yet, we need to see that you have contracts that if we give you the money, then you will have revenue to pay us back. So we're cash flow lenders, and if you can't make your monthly principal and interest payments, then there's nothing that we can do at that point, and you'd probably have to go to friends and family to get additional investment from them. But once you do have those contracts, or there is some revenue, then definitely come and have a chat with us, and we might be able to help you. And we do also give 6-month principal postponements for our working capital loans, so that gives you a chance to get your money working for you to be able to pay us back.
And are you typically looking at corporate security in this situation, or personal guarantees, or both?
So with this, we would just take the personal guarantees of the owner. So basically just a promise to pay us back, but there's no liens put on any personal assets whatsoever. Even if it was a later stage company and there was personal net worth and they're still just looking for a small loan, we would still do it unsecured. Just because you have a house doesn't mean we're going to put a lien on it. It's just not something that we do.
Okay. And Tanya, from the RBC perspective, what role does RBC play at this stage? And if it doesn't, what is it that you're looking for that isn't present?
So typically, so this was actually brought to RBC by EDC, actually former EDCer Shannon, who's now RBC, because we loved her so much, introduced the company to myself, and I think we came in year three, and at that point, we actually already knew that BDC had worked with the company before. The company obviously had like a growth trajectory, and they had kind of revenue base as well. RBC typically doesn't get involved pre-revenue, so you need to have at least a couple of years of revenues as well as financials as well to support that. We want to see there is some sort of a history in terms of financials, as well as your projections need to show that you have cash flow coming in for that year. So when we got involved, which was year 3, and if you move to the next slide, it'll actually talk about it.
Okay. Do you want to move there yet, or can we maybe just hear from EDC at this point? Do you want to?
Yeah.
Okay.
Yeah,
well, I'll flip forward, and then we can come back. Okay.
So year 3, when EDC introduced RBC to the company was already talking to EDC about accounts receivable insurance, and you can add it in a bit. But they had already talked to EDC about accounts receivables insurance. They obviously had debt in place from BDC. At this point, when RBC got involved, there was a history. So they had financials. The company was providing reporting as well. And at that point, we were looking at providing like a small operating line supported by the accounts receivable insurance by EDC. This is year 4, so do you want to jump in and just say how the accounts receivable insurance works?
Sure. So, and I'll also add, there's a lot of things that EDC can do in the early stages of your business. Typically, we come into the picture once you've been selling for quite some time, and you've gotten a first contract, an export contract. But there's a lot of information that we can provide, regardless of whether you're exporting or not. We have a lot of information on our website, and we always find that companies that come ahead of time and talk about the different solutions that are available can really help them in making their decisions if they decide to take a contract or not. So we always encourage you to come to us early days so that we can walk through what your plans are and you can be aware of the different solutions. Now, as Tanya said, once you get to that stage where you're at a commercial level at the bank, that's typically when EDC comes in and partners with the bank. And as I was saying earlier, our credit insurance can be leveraged by the bank in order to increase value for that asset. So your accounts receivable is generally the largest asset on your balance sheet. And when you're looking at a senior secured loan, the bank lends against your largest assets. So we insure your insurance. We provide 90% coverage. So the bank is able to margin your receivables at 90%. So it's a very quick way to add some value for your lending capacity. Typically in Canada, the banks will margin about 75% for your Canadian receivables. Once your receivables are outside of Canada, they'll typically give you no value. So by EDC coming in and guaranteeing, insuring those receivables for you, it automatically bumps that up to a 90%. So it's a really great thing to leverage and also protect you against your customers not paying you.
Yeah, thanks so much. So actually, that was really helpful for the company because the company had already been talking to EDC and already had accounts receivables insurance. It actually helped us bump up the line of credit from 75% margining to the 90% margining. And we already were comfortable with the fact that BDC was involved with the company and they had a good revenue history as well. Year 4, which is where this slide is, the company had grown up to revenues of about 2.5 million. They also were establishing a very big US base as well, and were trying to start opening or looking to open sales offices in the US. They were now coming to us and looking for a US operating line as well. And this is where EDC really comes in and provides us the ability to lend against US receivables. Again, typically we won't be comfortable lending against US receivables, but when EDC provides that accounts receivable insurance, we can actually set up an operating line for that. So EDC did provide the accounts receivable insurance policy where we set up a small US as well as Canadian. The Canadian line was already existent, but we also set up a small US line. And then what it also did was it allowed us to kind of get deeper in with the company. So we looked at their SR&ED tax credits. They had SR&ED tax credits as well as the history in filing for SR&ED tax credits. So something that a bank always looks for is whether it's OIDMTC or SR&ED, we always look for a history of successful filing. And the company by this point had a 2-year history of successful filing as well as receiving the tax credits. So EDC came in and provided a guarantee on those tax credits at up to, I think it was 50%. And RBC lent against those tax credits at 75%. So we established a couple of facilities at this point. The company was obviously doing really well and was growing pretty well as well. And we kind of kept working with the company. And I think at this point, BDC's facilities went up a little bit as well. And I think your BDC came in and provided a growth capital line as well for the company.
Amesika, can I ask a quick question about EDC, just to clarify, and I may have missed it, but 2 questions. Do you need foreign sales to trigger your involvement? And once EDC is involved, does EDC only provide guarantees or insurance with respect to the foreign component, or will it also provide insurance and bank guarantees against the Canadian sales?
Yeah, those are questions that we get often. For us to be involved, you have to be a Canadian company, number one, a legally registered company, and you have to be exporting, which means you have to have sales that are outside of Canada. So that can be the USA, that can be Mexico, that can be South America, wherever in the world. It just has to be, your customer has to be outside of Canada. Now, that being said, if, depending on the different solutions, there's different measures that we look at. But you could be a startup business, and if your first order is in the US, we can help you. So it doesn't matter how small you are, it doesn't matter what type of business you are, whether you are, a service provider in the digital media industry or you're a manufacturer, it does not matter. We service all companies of all sizes and all industries. And to your other point, it depends on what we are lending against. So when it comes to working capital needs, we look at the overall business. So there's different measures that we evaluate. But if there's a minimum amount of export business in sales in the business, then we will help lend with RBC as an example. If we're looking at contract-specific financing, yes, the contract has to be outside of Canada, but we can also consider domestic contracts as well if there is a substantive amount of the overall business that's export oriented. We always look for the export angle for everything that we touch.
Okay, so for example, if you're guaranteeing against the receivables or guaranteeing the receivables in order to enable a higher level of financing of those receivables, do you look at both Canadian and foreign? Okay.
Yes. So we can insure both your Canadian and foreign, but in order for us to insure your Canadian receivables, you have to have foreign receivables insured as well. Because of our mandate, we can't just do domestic receivables, we have to do both.
Amanda, is there did you want to make a comment about BDC's involvement at this stage?
I'll make a general comment. So just something to keep in mind is that when they're talking about lending against receivables for the banks, they don't mean BDC because we don't lend against receivables and we don't have lines of credit. We just have term loans. So where we would come in at this stage is if you had a growth project on top of what's going on here with the contracts, and say you're also expanding to a new market, so you need working capital to open a new office in, I don't know, the United Kingdom. So then we would give you working capital to do that. So it wouldn't have anything to do with your line of credit. EDC works a little bit more closely with the chartered banks than with BDC. We have a lot of the same clients, but it's not as really a codependent relationship like BDC and EDC is. So if you have a growth project, that's when you come to us for a term loan.
Perfect. Let's move on to the mature stage then. So at this point, the company has 6 years of revenue. It's now grown to $5 million a year with emphasis on large enterprise clients with multi-year contracts. The company had benefited from rising demand for mobile technology solutions, hence the growth. It had opened up additional international locations and now had an employee base of 70 people and had entered into enterprise partnerships to jointly bid on projects and was exploring strategic acquisition opportunities. So let's start with Tanya on the RBC's involvement at this stage.
Yeah, absolutely. So this is where you actually really start to see the innovative solutions that a bank as well as EDC can work together to provide to a client. So not only at this point, there were two separate lines of credits for Canadian as well as US with the EDC receivables insurance on the accounts receivables. But we also were setting up a term facility for their leasehold improvements for their US offices that they were trying to set up. So they were setting up sales offices in the US, and EDC was providing a guarantee for us to provide a term facility to set up those offices. Also at this point, and it's not on the slide, but we were also looking at putting in a performance security guarantee with an EDC, is it EGP?
It's our APSG.
APSG, sorry, which is basically a contract-based line based on a particular contract, and EDC comes in and provides a performance security guarantee against that contract. So the facilities were really starting to get very innovative and outside of the box. We weren't just traditionally looking at just working capital lines as well as term debt. We were actually looking at helping the company grow outside of Canada, as well as expand their borders, as well as kind of grow into the markets that they were looking to grow with the bigger contracts that they were getting. And BDC also provided growth capital. So the one thing that traditional banks would not do is growth capital, like
so you're talking
hiring.
Essentially venture capital?
It's
equity
more
based, or is it?
No, it's not equity based. It's more like just if you have to hire 70 more people. Typically your cash flow should be able to support that, and in cases where your cash flow is not supporting it, that's where BDC will come in and provide the growth capital for that. So you can
so you're talking about our growth in transition team at the moment. So there's our traditional financing, which is just a company that's steadily growing, can support the debt, but then there's cases where you're just growing so fast that you can't afford the debt for it, or you need to go to the VCs of the world or to private equity, but then you're giving up part of your company. So that's where our growth and transition team can come in and provide you a larger working capital term loan for that growth, because hiring someone, you can't take any collateral against it, so the banks have a little bit of trouble with that. And even on my team, the traditional financing, it's just too high of an unsecured amount. So that's when our growth and transition team comes in, and they have specialized terms, and they can get really creative with the financing that they can provide so that you can keep control of your company.
Perfect. And did you want to say anything about EDC's role at this point?
Yeah, I mean, these are the types of transactions we love because we want to encourage Canadian companies to expand globally. We partner very closely with the banks to encourage them to lend, to help these companies expand, opening up offices, expanding in terms of working capital. We can help finance a sales office or equipment in some cases if it's necessary. So there's a lot of scenarios that we come in and we partner with the bank to encourage that type of lending. And for us, it all ties back to the benefit to Canada, right? The more we support the company, the more their offices grow, they hire more people, and it all goes towards our mandate, which is to support the Canadian economy. So in this example, as Tanya had said, RBC is not comfortable generally financing these types of scenarios. So our financing guarantees are leveraged by the banks to take on that risk. And we go in there almost as a partner and sharing the security behind the loans. And I must also add, it's very important that when we are looking to lend, we look at the financial strength of your business. We want to make sure that your business can afford to take on this added debt. We don't want to hurt you by giving you debt that you can't afford. So we really work very closely with your bank to determine the amount of debt that you can take on at this time. But keep in mind that just because we may not give you everything that you need today, doesn't mean that we can't grow with you as your business grows in a short time period throughout the course of the year. We know a lot of companies in the digital media industry can grow very quickly. All it takes is one contract and it can sometimes double your sales. So we're very agile and proactive in trying to work with you, with your bank, to try to help finance these types of scenarios.
Can I ask you just to address a particular scenario that may not have been evident from this case study? Mm-hmm. In some of the interactive digital media businesses, there will be large pre-sales or publishing advances or guarantees. So they're large single contracts that the bank is unlikely to want to finance because they come from external buyers, for lack of a better word, and so the bank may not have a lot of visibility in terms of their the likelihood of them paying. How does EDC have a product for that?
In terms of helping to finance these
specific receivables insurance on specific larger contracts?
Yeah, so there's two parts to that. So the first part is the risk mitigation aspect of it. So when we're looking at insuring a contract, we look at the customer in which you're doing business and we do a credit check on them and determine whether they're credit worthy. There are some cases where we will come back and say no. That we've seen something in their financial history or in their current financial standing that makes us unable to extend that credit, which can also help you when deciding whether to do business with them. Because if we tell them, no, we can't insure that, that's probably your first red flag that you shouldn't be doing business with them. We know a lot of companies feel that if they're doing business in the US, for an example, or they're doing business with a large enterprise, that, oh, I'm good, I don't need to worry because, that business is really big. But you never know what's going on behind the scenes. And I always use the Target Canada excuse that we did not see that coming, and overnight they went bankrupt and they were gone. So, and a lot of companies were hurt because of that. So insurance is about protecting your business, protecting your investments. So that's just one aspect of it. What the insurance does is just make sure that you get paid, but often it can't ensure how you actually finance the contract if you've won it. Right. So we evaluate all of those factors along with your bank to see whether, as a company, you have the ability to do the contract, As Tanya said, your ability to be able to pay back the loan if you are awarded it. So we work very closely in leveraging multiple solutions to help finance those types of contracts.
Perfect, thank you. I'm going to ask one other quick question, then I'm going to open it up for the floor. I forget, what's, Krista, what's our timing on this? Okay, Samantha, maybe Samantha knows the timing. Okay. Anyway, we'll carry on for a minute. Just one other quick question. This has been about business-to-business digital media client. And at least I gather that from some of the language, their emphasis on large enterprise clients. I'm wondering, how does each of your solution work, and maybe it's exactly the same way, in a business-to-consumer situation? A lot of interactive digital media companies will be, for example, putting up a game on Steam, in some other way distributing to an international consumer base. Let's start with EDC. Is that the kind of foreign sale that you recognize?
So when you say B2 consumer, you mean selling to online?
Yes. Selling the product directly to the consumer.
Directly to the consumer.
Right.
So typically in those scenarios, the customer is usually paying up front. So we don't tend to get involved in that. Where we typically would see a scenario like that is if they were selling into a distribution network or retail stores, something like that, we would probably get involved in, but less so business to consumer.
Okay, you're not because you're not providing general corporate guarantees to the banks. You're just providing receivables guarantees or contractual guarantees. Is that right?
So there's two parts. So we are providing insurance to the Canadian company to protect their receivables, and the banks take advantage of that as part of their lending from that standpoint. But again, it doesn't protect the bank against the Canadian company not paying off their loan. So the other solution that we offer, which is our financing guarantee, is a guarantee that we extend to your bank, which then the bank is essentially the client on behalf of the Canadian company, where we make the bank comfortable in their lending by providing that guarantee in the case something goes wrong. So there's two sides of it. There's the protection of the Canadian company, and then there's the protection of the bank against the loan being repaid.
Right, and that second aspect, does that extend to business-to-consumer businesses?
Yeah, absolutely.
Yeah. So digital media
working
companies,
capital expenses.
Right.
Yeah.
So digital media companies that are selling to consumers, direct to consumers.
Yeah, and they need working capital.
Right. Still
exactly.
have a product at EDC that would fit their needs.
Exactly. Yeah.
Any other comments on?
Yeah, so same with us. What you're typically referring to are digital media and gaming companies. So gaming companies have business to consumer games where people who play the games would actually buy the products directly. At that point, you're really looking at the user acquisition strategies. You're also relying on the company's cash flow and the financials of the company as well. So it's on a case-by-case basis. But yeah, where EDC provides the guarantee or receivables insurance, it kind of gets the bank comfortable almost immediately to extend the facility, and provided the financials are all okay, to extend the facility and move forward with it.
With BDC, whether you're B2B or B2C, it doesn't matter to us. We just like to get to understand the business, the financials, the owners, what their background is, and just understand what the project is and does it make sense for your business no matter what the business is.
Okay. Thank you very much. Let me open it up to questions. Yes, go ahead. So I'm not sure the question was heard, but the question was asking about BDC Ventures.
You mean our venture capital?
Yeah, I'm saying you left off a very important aspect of finance you provide that work hand in hand with the
So we do have our venture capital team. They look for very specific companies, and typically the ones that we meet aren't a fit to refer to VC. So we were just focusing on the term debt. But for them, they look for companies that are in high growth. They've been around for a long time. They have numbers that they look for in the EBITDA and revenue. I'm not sure exactly what they are, but if you're a very high growth company, very strong, and you're looking for that, then I mean, you're welcome to reach out to them. They're in the Mars building, but they do look for very specific criteria. So it's not startup VC financing. They don't provide equity or VC financing at that stage. It's when you're more established.
Okay. Any other questions? Yes, Shannon.
So more so for the panel, question is, how do your companies or your organizations get involved with companies in this space that oftentimes are growing through acquiring another business, whether that be domestic or international? Maybe each of you could speak to that.
So the question is, for the panel, how do you deal with companies that may be growing through acquisitions?
Yeah, absolutely. So we actually provide acquisition financing for companies that are looking to acquire other companies. Typically, the criteria for that is the company itself, their cash flows should be able to support the debt that they're looking at, as well as the company that they're looking to acquire should have positive cash flows as well. Again, it's on a case-by-case basis, but we actually absolutely provide acquisition financing provided if the companies are cash flow positive. So.
And we typically come into the picture along with the bank, if the bank asks us to, if you are acquiring a business that will add to your overall business, which can be tied to your international growth. So, for example, if by acquiring a U.S. company, because that's going to get you access to a certain market share to grow your business into the USA or into Latin America or into Europe, we can come into the picture and partner with your bank to be able to finance those types of transactions as well.
And BDC also does transition financing, so it depends on how big the purchase price is and what's involved. Is it an asset purchase, a share purchase? How much is secured? Is there a building involved? Is it all working capital? Then either my team or the growth and transition team can help with the transition financing. One thing that BDC can do, and I'm not sure if the chartered banks can, is if there's a vendor take back involved. So if and it's postponed for the term of our loan. So say we're going to do a term loan for, I don't know, $500,000, and that's over 5 years. And if the sellers are willing to postpone getting paid X amount of their purchase price, say $200,000, if they postpone that, then we can include that $200,000 as equity in the business. So it puts the ratios, in a better spot for the purchase. So that's something creative that we're able to do. I'm not sure.
Yeah, we actually have done that in the past. Again, it really depends on the strength of the company. The financials really need to be strong at that point if we're looking to do something like that. But yeah, we look at doing that as well.
Other questions? Thank you very, very much. I appreciate it. And if there are other comments from the panel that you...
Yeah, just one comment that I would say to kind of end the panel is that I think you all saw at each one of the stages of growth throughout the company how each one of us got involved. But the most important point was that we were all working together at each one of these stages. We were all keeping in touch with each other. We were actually, if there was a request coming from the client, we were just picking up the phone and going on joint calls. The point that I'm trying to make is it is a big ecosystem, and the three of us together are trying to support that ecosystem and kind of work together in that. And that's what I think is one of the key things to come to kind of put across from this panel.
Yes, Chris. You're allowed.
Thank you. I love the ecosystem and it's kind of passing this client through various stages of maturity. I'm curious to understand how many clients actually succeed through practicing the 3 steps of maturity, and are you seeing more and more from the digital media industry?
So Krista's question is, how many clients do you see who have this kind of success story, and how many of those are from the digital media industry?
So I can take the first go on that. Quite a few of the clients that are digital media clients, and my colleagues here, Shannon and Joy, can add on to that as well, that we see have actually either worked with BDC or EDC before they come to RBC. So some of the bigger names that you can think of have absolutely worked with all three of us in different capacity and are still working with us as well as EDC to put financing solutions in place. It's now becoming more and more kind of important to work together with all of us to throughout the different stages of growth. A lot of the companies in the digital media space actually have really high and very fast growth trajectories. So, a BDC and then an RBC and EDC kind of is a natural transition where, at the initial stages, a chartered bank cannot get involved, and that's where BDC comes in. But at a later stage when, they're really starting to grow, there's joint financing solutions from each one of us.
Yeah, I would agree that we do see this very commonly for companies in this space because they grow very quickly. And as more and more companies are coming to the Toronto area, we see it all across the GTA that companies are expanding, and they're expanding very quickly. And where I see a lot of companies is that they grow very quickly and then they reach a ceiling. And usually that ceiling, it comes to financing. Either require more senior secured debt financing, or often they have to go to VC. And so they can be very challenged in that regard. And sometimes, there's nothing that we can do. And sometimes we make the recommendations to other parties that can support. The unfortunate thing with senior secured lending is that there has to be something to lend against. So for a lot of companies in this space, unless they have a lot of cash or they have a lot of other equity that's in the business, sometimes it can be a challenge. But we do try to work together to try to find the right solution for those companies. As I said, for us, we look at each and every company very differently. So we don't, place every company under the same lens. We look at them very differently because there's a lot of factors that we look at in addition to just financing. We look at management, we look at the product itself, the software itself that they're designing. There's a lot of factors that we look at to try to determine how to support. But I think more and more we see companies move through these phases very, very quickly, which can be a challenge because then we're all trying to catch up with how quickly they're growing.
Yeah, I don't have much to add to that. In terms of the partnerships, whenever a client comes to us, they always have a relationship with their chartered bank because we don't replace that, we just complement that. So for 100% of our transactions, there is an RBC of the world involved. For EDC, we do see that a little more typically, I guess, with our larger clients. We are trying to let our smaller clients know about EDC and the benefits. And I think it's just when you have smaller contracts, you're maybe not as aware of those kinds of services. Whereas if you're a multi-million-dollar company and most of your sales are experts, then you probably already do. So we do try to facilitate those introductions, and that is, another value add that we all like to provide to our clients is to connect them to either one of us or someone else in the community who's able to help where we're not. And downtown, we are seeing a lot of the digital media companies, especially because, we're right in the middle of it. So yeah, we're trying to put a bit of a focus on helping these companies out as well.
One other thing that just realized we hadn't talked about the cost side of things. People are probably fairly familiar with the chartered bank lending rates and the concept of prime plus risk percentage. Tanya, please feel free to address that. But I think it also might be helpful to understand what BDC charges in general, obviously. The range for its slightly higher risk financing, and then also what EDC charges for its insurance and its guarantee products.
You want me to go?
Go ahead.
So for credit insurance, it's a premium structure. And as I said earlier, we look at your customer, we look at the credit strength of your customer and the country in which you're doing business. So higher risk countries, probably a higher risk premium, lower risk country, lower premium. But to give you a sense of number, I always like to say in and around 1%. So the higher risk, a little bit higher than 1, the lower the risk, below 1. When it comes to our financial guarantees, again, we look at your company's financial strength and we look at the amount that we are guaranteeing, which is generally guided by the bank. The bank will ask us to guarantee a certain percentage and how that money is going to be used. If on day one you're going to go liquidate the entire loan and spend it all versus spending over the course of the year in installments. So we look at that. And generally the rates are in and around 2 to 3.5%. So our rate is a one-time fee that we charge, but of course that's over on top of what the bank is charging as well. Now, I will say that we really try to make sure that we're charging the right amount for you. So if your bank is able to finance you on their own, that is always going to be your easiest, cheapest option, and we always recommend that. But we are invited in when the bank is not able to do that. So yes, there is an added cost, but often the cost benefit could be that you're now able to access a lot more financing than you would have if we weren't in the picture. So it goes with.
It's the number that you gave, particularly for the credit insurance of 1%, is really quite. It's strikingly low, actually, when you think that what you're doing is you're taking a major receivable or group of receivables that are otherwise not financeable, that for which you are going to carry them for 30 days, 60 days, 90 days, and they essentially are lost to your business for that period of time, and you're turning them into something that a traditional bank can finance. At 1% is a very seems like a very good deal from the company's perspective. Can I ask you quickly, and then we'll come back to the others on or to BDC on pricing, but there is an EDC product, is there not, that can actually be accessed online? You have a streamlined process now for credit insurance.
Correct, yes.
Can you talk about that just a little bit,
absolutely.
because it might actually be quite relevant to this audience?
Yes, absolutely. So as I was saying earlier, our insurance solutions can be catered to your specific company's needs. So depending on whether you just want to insure one contract or you want to insure multiple contracts or your entire business. And you're exactly right. A couple of years ago, we launched an online insurance product where you can literally go online, apply for credit, and get approved within a number of minutes. It can really be that simple. And that's catered towards those very easy, low-touch, one-off contracts that you might have. And that pricing is also very competitive and quite reasonable as well.
Perfect.
And you can do that from the comforts of your home.
What you can also do from the comforts of your own home is apply for up to $100,000 at bdc.ca if you've been in business for 2 years. So within 5 business days, not within 5 seconds, you can be approved for up to $100,000. So back to pricing, we are generally a little bit higher than the chartered banks are. We started our floating base rate of 5.3%, and then there is a risk variance on top of that. For the working capital, it's anywhere from 0 to 7%. So that depends on the strength of the business, the strength of the owner's personal net worth. Number of factors go into determining what that interest rate is. But if you come and talk to us, then we'll look at everything and put everything into our system and have a term sheet for you that will say exactly what the loan's going to look like, what the interest rate's like before you pay anything. So it's always still worth a conversation. And with us, we never compete on rate. If you're looking for the cheapest rate out there, then for sure go to your chartered banks, because if you come to us, you're just going to pay us out a year later. So we don't want that. We're in it for the long run with you, and we really look to have a relationship relationship with the entrepreneurs that we support and help them through their growth. So if you just want the cheapest rate, for sure, talk to Tanya. But if you are looking for more flexible terms or just to diversify where all your debt is, then BDC is a good option. Like I said before, we do principal postponements at the outset of all loans, and we are able to say if you're in a cash flow crunch, a couple years into the loan, and you could use another additional 6 months postponement of interest payments, we can do that, principal payments, we can do that fairly easily. And we just really look to support, and we're a non-demand lender, so we're never going to call your loan, which is also, it's a big factor. You don't want somebody to just say, hey, tomorrow we need the $100,000 we gave you back. So we've got clients that way, but we don't lose them that way.
Thank you. And Tanya, did you want to speak briefly about rates?
Yeah, so typically there's a one-time application fee for us, and then obviously like on the actual facility it's a prime plus. I don't like to quote numbers, but it's a prime plus 1.5 and anything up and above from that, because it really depends on the company's financials and the strength of the company. What I would say, and companies should keep that in mind, is that when the facilities grow up to a certain point, we do like to engage external legal counsel, and the company does pay for the external legal counsel cost as well. So again, the key point here is ecosystem. When you're building and you're working in an ecosystem, not just the financing providers, but also have your own accounting firm, have your own law firm kind of represent you as well, and just have all ducks in a row before you come to us for financing. So it just makes things a lot easier if our legal counsel is dealing with your legal counsel in terms of negotiation as well, and keeps the fees on the low end side as well.
Okay. Any other questions? Well, thank you very much, and thank you to our panelists.
Thank you.
Thank you.